Right, evening everybody. Thank you very much for coming. It's typical that the weather would change just on the day that we're having a presentation, but do appreciate everybody coming out, and hopefully the atmosphere is warm and the drinks cold, but the food is warm at the end. So it's lovely to have everybody here. Right, there's only one thing to talk about tonight, and that's the Straits. And I suppose what we have to try and get down to is whether we're heading for a straight jacket, because we're all going to go stir crazy by the end of this, or whether it's sort of plain sailing or straight sailing from here. It's not immediately clear what the answer is to that question, but let's see if over the course of the next sort of 45 minutes we can shed a little bit of light on what we think and how we think and how we approach what's going on. It's amazing. Back in February, you might remember we had the budget. We were very positive. It was a very positive budget. And I was writing some reports for trusts that we administer. And one of the sort of closing sentences was, the outlook hasn't looked this positive for 10 years. And then 3 days later, war breaks out and everything changes on its head. Such is the nature of investments. Markets are always there, but things can change at the drop of a hat. Right, so let's start off with just kind of the world in pictures a little bit. The Economist is a wonderful magazine, and for those who subscribe to it, it's actually fascinating that every week they send out a newsletter just telling you the process that they've gone through to choose that week's cover, which in itself is actually a pretty interesting read, because you might think that each cover of The Economist is quite simple, but they probably go through 15 or 20 reiterations before they choose the right one and they get the right context and meaning and things like that, which is actually it's an interesting read, if nothing else. But it's a great magazine, and they obviously sum up things pretty well. And we started the year, so actually the first picture there was actually from an issue in early January, and even back then there was angst over affordability, yet alone what we're facing right now, sort of 5-6 months down the line. But there is angst over affordability across the world. I think we can all appreciate that the war in Iran is actually an attack on the world economy. Every country is affected. Everybody's affected by this. It's not as isolated as, for example, the Russia-Ukraine war. The effects are really global in nature. I think it's fair to say that for the last month it's been advantage Iran. I certainly think that the war hasn't played out how the US would have anticipated it would have played out, and I don't want to get into a long debate on that. We'll be here all night. I'm not sure we've got enough red wine for all that, but we certainly wouldn't have expected, the last sort of what's happened in the last maybe 5 or 6 weeks to unfold as it has. And then while all the war's going on and everybody's focused on that, there's other things happening in the world too, and relationships between the world superpowers are interesting, to say the least. That's probably the most polite word that we can use to describe what's going on. But there's a lot of things going on at the moment in the world, and let's try and make sense of it all. So I think one of the really interesting things is we all know what's happening to oil prices, what's happening to gas prices. I think if you just look at the chart on the left there, natural gas prices are obviously soaring, oil prices are soaring. The scale is a little bit misleading, and it doesn't look like oil prices have done a lot, but they actually have done a lot, especially since their lows down towards the end of last year. But obviously some of the moves were dwarfed by the fact that we had this massive spike in natural gas prices in 2022 when Russia invaded Ukraine, and obviously Russian supply essentially came off the market because of sanctions. So, but if you just look at the middle chart, ammonia prices are obviously soaring. That's obviously a concern for farmers around the world, including ours. Ethylene, which is used in plastics, is soaring. So again, these moves don't look particularly big in isolation against the last sort of 8 or 9 years, but actually they are big moves, and they obviously then feed through into every other thing that often gets made or are downstream products of that. And yet, if you look at the chart on the right, markets are actually amazingly saying, go on. Emerging markets are not at record highs, but they are doing extremely well this year. The US is doing well. And so how can you say, I mean, if I said to you 6 or 9 months ago, sure, next year we're going to have a war in Iran, the Straits of Hormuz are going to be closed, oil price, we would have said that markets would be down 25, 30% at least. Oil prices would be $150 a barrel. And why hasn't that happened? Well, maybe in a nutshell, why markets haven't behaved like that is because of two letters, AI. And I'm not going to talk much about AI tonight because we've talked about that before. But really, I suppose, despite what's going on in the world on one side, the world continues, and there's a lot of stuff going on in the world in other aspects, which is equally exciting. So I think maybe one of the messages that I'm going to repeat tonight, probably repeat a few times, is probably one of the toughest things at the moment is to actually stand back from the headlines, not to get too caught up in all the daily headlines, because it'll drive you crazy. I mean, if you look at the headlines in the morning versus the afternoon, they've changed. And you don't know what to believe or not. You don't know whether the headline's true or not. So go and have a walk, go on holiday, go and do anything but look at the headlines, and the world continues. So let's just delve a little bit more into oil prices. And again, I think most people have been surprised by the reaction of oil prices, because if you'd said, not in the world's history has the Strait of Hormuz ever been closed. Not in World War I, not in World War II, not in the Iran-Iraq war, not in the Kuwait war. It's never ever been closed before. It's essentially a doomsday scenario, closing the Strait of Hormuz. And yet, oil prices are $100 a barrel. They're not higher. And one of the main reasons for that is that we actually started the year with record high oil inventories around the world. So the yellow line is what happened last year. As you can see, over the course of the year, stockpiles around the world just grew and grew and grew. So where the yellow line leaves off at the end of last year is where the blue line, the light blue line, starts at the start of this year. But you can see how quickly that line is falling now, and oil stockpiles are being drawn down aggressively, which is exactly why you have stockpiles, but they don't last forever. So 250 million barrels of oil has been drawn down from inventories, and another 315 million barrels from strategic reserves. That's like the US Strategic Reserve and other countries that do have these reserves. But now we're entering a period where there's seasonally higher demand. Obviously in the US, everybody hops in their cars. Their cars aren't the most fuel-efficient cars anyway, and everybody goes on their summer holidays. So oil demand typically rises in the summer anyway. But also, so there is some demand destruction going on. And typically when you look at periods like this where the oil price does shoot up a lot, in 5 to 10 years' time, we will look back on this moment and we will see a dramatic change in consumer behavior going forward. We'll all make different decisions because there's an incentive to make a different decision at the moment. There's an incentive to buy electric cars. There's an incentive to think about doing things differently. There's not a lot of incentive when prices are really cheap. But I'm sure if we look back in even a couple of years' time, we will see that consumer behavior is changing as we speak at the moment because of what's happening. And people don't want to be held hostage any longer, so the world's going to change too. But I think one of the challenges, and I'm going to come to it in a slide in a moment, is even if the war stopped tomorrow, the challenge is that oil prices will probably stay around $100 a barrel for the rest of the year. And you can say sort of, why is that? So initially, if the headlines pop out and say, there's a truce or there's a settlement, I'm sure oil prices will fall in the next day or two. Just that's markets. But one of the problems with oil is that obviously some of the oil fields have been shuttered or production has been reduced, and you don't just ramp up production overnight again. It takes time to ramp up production and to bring oil fields back online. It's a complicated business. But the second thing is that even from a shipping point of view, the ships aren't in the right places anymore. If you think of a school or any sort of calendar, and it's a tightly oiled machine and everybody knows exactly where they're going to be, and you think of a global shipping, where all these ships are around the world, now obviously ship owners have sent their ships elsewhere, they're going on different routes, they're doing different things, and if the Strait reopens tomorrow, those ships aren't there. Yes, the ones that are trapped there will get out, but the empty vessels to come and take oil are nowhere near the Gulf at the moment. And so it'll probably take sort of 30 to 45 days for shipping to even resume some sort of normal pattern, to get from Asia back to the Gulf or whatever the case is. So even if there is an end to the war, we can probably see oil prices staying around about $100 a barrel for the rest of the year. That's obviously not great if you think of where petrol prices are and the pressure on that. But then the benefit of that is that oil prices should fall very sharply into the new year. So going into 2027, you should see a very sharp fall in oil prices because there will be essentially an oversupply. Everybody's got a huge incentive at the moment to produce as much oil as they can because they can sell it at a very high price. But as soon as things start to normalize, production won't slow down. You'll still have people selling as much oil as they can. And stockpiles will be built, and then into 2027, you could see a situation where oil prices are again back in the $70 sort of dollars a barrel, and that's obviously then going to be very disinflationary, which is a good thing. So it might be a little bit of short-term pain this year for a benefit next year, but obviously it very much depends on what's going to happen and how long this war is going to last for. So the sort of longevity of war. I think it's probably true to say that we've probably been in a stalemate for the last sort of 6 weeks on this war. I don't know I can't remember exactly the date that the ceasefire started or was meant to have started, but I think markets have started to get a little bit jittery that we are in a stalemate, and I'm going to come onto it in the next slide again. But if you just look at where inflation is, the light blue line just shows inflation expectations 1 year down the line. And you can see that obviously expectations are for higher inflation. The US, this is the same in every country, but I've just used the US as an example just because I don't want to clutter up the charts too much. But the US has an inflation target of 2%. So if you're going to have an inflation of 4 or 4.5% over the next year, well, that creates some problems for the Federal Reserve. There's no doubt about it. So what we have seen is interest rates start to rise. So very few central banks have raised short-term interest rates. The ECB has, the Bank of England is wavering, the Federal Reserve hasn't yet. Our Reserve Bank raised interest rates last week for the first time. But what has happened is that bond yields, which are essentially long-term interest rates, have started rising quite aggressively. And if you just look at the chart in the middle, there's a couple of things that I really want to draw your attention to here. The two blue lines are the US and the UK. Interest rates are really as high as they've been since the financial crisis. This chart doesn't go all the way back to 2006. But interest rates haven't been this high for really 20 years. That's in itself, as I want you to remember, that's an important point. And the same is essentially happening in Europe, although they're slightly lower than other things. But I also want to point out what's happening in our country. Look at the yellow line. The yellow is for gold. You've got to use yellow for South Africa. We're in a completely different cycle. So 2 or 3 years ago, we stood here and we were at the peak of load shedding. We probably had the generator on now because we would have been in the middle of load shedding. And things were pretty dire. Government finances were horrible. But the reform momentum was underway, and we said that we could see improvements coming. And then obviously those improvements really started to manifest themselves over this course of the end of 2024 into 2025, the GNU, and then obviously the last sort of 2 budgets have been very, very, very market friendly, the one at the end of last year and the one in February. But you can see what's happened to our bond yields. And we were talking to you in March, I think we were saying this in March, maybe it was an intuition, but we've really reaped the benefit of having lower interest rates. So government can borrow at a lower rate. They don't have to issue as much bonds. They pay lower interest. That obviously helps our budget deficit, and it just moves everything onto a much firmer footing. But you're finding now that the US and the UK are in exactly the opposite cycle, and Europe are in exactly the opposite cycle. A lot of the debt that was issued between 2012 and 2017, 2018 comes up for maturity in the US now. 25% of all their debt matures in the next 18 months, and they have roughly $40 trillion of debt. All that debt was issued when interest rates were 1.5%, 2%. Now interest rates are 4.5%, 5%, and they have to reissue that debt. And so they have to issue a lot more debt because interest rates aren't 1 or 2%, and they have to pay a lot more interest on that debt going forward. And obviously that's something that we're very well aware of in this country because that's exactly the trap that we've been in for so many years, and we are finally getting out of it. But it's taken a long time, and it's taken quite a lot of heartache and austerity to get us there. So I think maybe the message is that short-term interest rates haven't really started moving yet. So the weaker consumer spending is essentially still to come, but it's obviously a risk. But obviously that then feeds through to slowing growth. But when you have long-term interest rates rising, as in the chart here, that then puts pressure on equity valuations, because that's one of the inputs into how you value shares. But it also raises this big issue of refinancing risk. And these big countries, all these Western countries, having to refinance a lot of debt at significantly higher interest rates. And I can tell you that Trump and his cronies in the White House will be very aware of this. So if there is an incentive to get things back to normal, this is certainly one of them. And that's going to continue to make investors diversify away from the dollar and into other assets, including gold. So some of these big sort of macro trends haven't really gone away, despite what's happening in the war. So I know you're going to ask me this at the end, so I might as well just get it out of the way and deal with it. So what now? Where do we stand on the war? I mean, as I said to you, if I go into the office tomorrow morning, there's a headline. If I look at lunchtime, there's different headlines. Headlines popping up as we left were Trump is in the final negotiations for the war. I mean, we've heard that probably 20 times over the last month. So I encourage you not to look at the headlines because it just actually drives you insane. But we do have to try and make some sort of sense of what's going on. So let's try and make sense of it. So obviously the one scenario is that we do have a comprehensive ceasefire or a peace deal and the Strait's reopened to shipping. As I said before, we'd probably still expect oil prices to be in that range. They're not going to go back to where they were. But obviously it's good news for monetary policy. The Federal Reserve hasn't raised interest rates yet. They would probably hold off. Other central banks would probably also hold off. The European Union or the ECB has already raised rates. Our Reserve Bank raised interest rates last week, but we probably wouldn't get any more hikes in interest rates, which is obviously good news. And equity markets would love that they would be firm. They would focus on AI and all the stuff that's going on in AI, and it would essentially be business as usual. The dollar would continue to weaken, gold and platinum would rally, and generally it would be business as usual. That's the one scenario. The other scenario is that this sort of stalemate that we've been in for the last 6 or 7 weeks continues, where we have this blockade continuing. There's no real progress. I think there is a feeling out there in the world that this could continue for a lot longer because in the absence of a crisis, what makes either the US or Iran really compromise? So unless oil prices go to 150 or something, what is the catalyst to bring these guys to actually start compromising? Because both sides need to compromise. That's always the case. There's no right or wrong. But what is going to be the trigger for the compromises to be made? And there's a feeling that maybe we have to actually get to crisis stage before that trigger is pulled, unfortunately. Let's hope it's not, but there is obviously that risk. So then we're going to, if the stalemate continues, $95 to $115 a barrel on probably oil. But every week that we continue from here into June and into July, the risk on the oil price goes up and up because those stockpiles come down and the whole oil market globally just gets more and more tight and more and more difficult. Then we're going to start to see central banks starting to hike rates quite aggressively. I'm sure our Reserve Bank would also increase interest rates again in July when they next meet in July. And we certainly wouldn't be looking for interest rate cuts before the end of the year or even maybe into the sort of second quarter of 2027. And obviously that's going to be associated with weak equity markets, a lot of volatility, a lot of reactions to headlines. Every day you can just look at the screen and tell if a good headline or a bad headline's come out because the market's sort of going like that, which is ridiculous, but that's how it is. And yes, the dollar would probably weaken, gold would be stagnant. Obviously, another scenario is that there's actually a renewal of hostilities. Actually, war breaks out. I know there's been a few skirmishes over the last week, kind of bombing each other, but we're still friendly. The ceasefire's still there, but we've just dropped a few bombs on you today just to remind you that we're here. So yeah, I mean, that's obviously the worst case scenario. And then obviously we would have aggressive monetary tightening because oil would probably shoot up. It would really, I mean, if hostilities broke out, it would really push the end of the war probably towards the end of the year, and markets would take extreme fright at that. So then we would have a bear market. and it would really be because of higher interest rates, weaker growth, rising risk premium. The dollar would probably strengthen in that scenario as a kind of flight to safety, and precious metals, gold, and things would decline. So what probability do we ascribe to that? Sort of 90% that we're not going to get worse than we are at the moment. That's not overly encouraging. And there's probably a 40% chance that we do have some sort of ceasefire or some sort of peace deal in the next 2-3 weeks. But as I said, I think there's a growing concern in markets and from commentators that in order to get to a ceasefire, we have to have some sort of crisis point before that actually focuses the minds of everybody and gets them to negotiate properly. Let's hope it's not the case, but I suppose that is the risk. Right, so let's just bring it back home a little bit and talk about what's happening here. I'm sure that you all know, without even looking at the chart on the left, what petrol prices are, because it's just absolutely horrible. And I'm sure you've seen all the memes that go around on social media about being held up by your local petrol pump and being robbed blind and things like that, which is exactly the case. But if you just look at where petrol prices were, I think what's really frustrating for us as South Africans is that a cyclical recovery was unfolding here and things were starting to look a little bit better, and petrol prices were right at the bottom, the lowest they've been in sort of 4 or 5 years, and then suddenly we've had this war, which is obviously completely outside of our control, and everything's been turned on its head. But I just wanted to show you the chart in the middle, and that's how the petrol price is calculated. So petrol and diesel are slightly different calculations, but obviously, the one thing we have to remember, and it started to happen in June when I did this presentation in May, it hadn't happened yet, but Treasury did offer some concessions, and they took the tax away from petrol for sort of 2 months, and that cost them sort of 17 billion rand. So that little light block under the January columns is the tax. That it's 4.15 rand a litre roughly on petrol and diesel. And they obviously reduced that to virtually zero for the 2 months. Now, in June and July, they're reinstating that tax. So in June, it was another sort of 2.10 rand that is clawed back, and in July, it'll be the rest of the sort of 2.05 rand tax that's clawed back. So if oil prices, so the basic fuel price is a combination of oil prices, the rand, refining margins in Asia, and all the other things that actually make up the sort of cost of getting oil or petrol or diesel to our shores, and then all the other things are local taxes and transport. But obviously, if the dark blue bar at the bottom doesn't start to fall, that's why we actually saw an increase in petrol prices this month, even though there was a fall in diesel prices, is because some of that tax is being written back. And we still have the other half of the tax to come next month as well. So it's not to say that if oil prices stay stable at $95 a barrel or anything like that, that we're actually going to see petrol prices stabilize, because we have to take account of the tax. And then unfortunately, just a lot of our stuff comes from the Gulf. So on fertilizer, 28% of our fertilizer comes from the Gulf, and 72% of our petroleum products come from the sort of Gulf region. So it's not just Iran, it's obviously Qatar, Kuwait, Saudi, that whole area. But 35% of essentially input costs for farmers is fertilizer. Another 20 to 30% of input costs is diesel. 80% of all our maize or grain gets transported by road, which is obviously diesel-based. And then what we're not talking about yet, but which we probably are going to talk about a lot in the next couple of months, is this what's kind of being referred to as Godzilla El Nino that's building. So those of you who've lived in Howick for a long time, the Porter family are one, but in 1982, you could walk across Midmar. It was that empty. There was literally no water in Midmar. And I think, if I remember, we were 300 or 400 liters of water a day that we were allowed per family back in those days. Forecasters are saying that this El Nino that's building at the moment is as bad as the drought that caused, in the early 1900s, the one that caused the drought in 82, 83, even the droughts in sort of 15, 16, 17. So there's a lot of concern globally. It obviously doesn't always mean that there's absolutely devastating drought conditions here, but the odds are above average that we are going to be heading into drought conditions as early as next month, I suppose. So it's just another concern. So if you put all that together, Food prices are going up. There's just no other way to say it, and that obviously impacts on inflation, that impacts on the Reserve Bank's call as to whether to put interest rates up. So if you go and stock up your pantry, because it's very hard to see food prices not going up in the next sort of 3 to 4 to 6 months. There's a lot of pressure coming through the system that's going to make life a little bit more difficult in the short term. But the good news is that the long term, the outlook is still brighter. And I think what's really frustrating for us is that that this year, as South Africans, I mean, obviously, as I said earlier, we were having a cyclical recovery. Things were improving very nicely. And then through no fault of our own, things have been derailed by a war that's outside of our control. But if you just think back on electricity, the reforms in electricity started in December 2020. In June 2023, we had 8 or 9 hours of load shedding a day. And that was 3 years after the reform started. Now, Eskom's just celebrated 365 days without load shedding. We should be delighted. But if we remember where we've come from, it actually is a pretty big milestone. And if you just look at the chart on the left there, 80% of Eskom's fleet is either planned maintenance or working properly. It's not the sort of 60% that we had just 18 months ago. And fortunately, the same thing is happening on rail. Rail reforms probably started 3 years ago. We are going to see private sector trains on our railways from Q1 next year. All the tenders were announced about 3 weeks ago. There's a lot happening on the rail side. Transnet is a different company and a different entity what it was, even 3 years ago, 4 years ago. There's a huge amount of activity happening there, but it's really, really exciting. And I think what it also does show to business and to big businesses is that the future isn't the same as the past. There's a different future. There's a lot of investment going into railways. There's a lot of rehabilitation going on. And if you're a train spotter, I'm sure next year you can go and sit in the Midlands and have a coffee and watch some different trains trundling up and down, because it is coming, but it's been quite a long time coming. So we can start talking. We probably started talking about these reforms 2 or 3 years ago, and everybody in the room is like, well, I don't see any difference. And when I drive on the N3, all I see is one truck after the other. But obviously it takes time for these things to happen. But when they do start happening, the momentum is irreversible. And that's really where we are at the moment. So, really going into the end of this year and into next year, we're going to start seeing some of these rail reforms coming through. And it's a game changer for our economy. I mean, Transnet has been so inefficient for so long. When we have some private sector competition in railways and investment in new capacity, we can take advantage of high commodity prices. We can export more coal. We can export more iron ore, because actually the trains are moving and the railways are in good shape. And then maybe one of the slightly sort of side effects of what's going on at the moment is that commodity prices are quite high. Obviously, especially gold and platinum, they've been higher than they have been for a couple of years. And the benefit of that is that the government's going to collect a lot more tax. So hopefully they don't have to tax us to death as much as they would like. But they are going to collect a lot more tax from the mining industry over the next year or two because of mining royalties. And that's what gave the government a little bit of leeway to reduce the fuel tax for 2 months and just give us a little bit of respite from that. But it also means that government's finances remain in relatively good shape. And our interest rate cycle and our bond market and all the things that have got us so excited over the last year kind of continue. So for us as a country, there's maybe a silver lining. And now I just really want to point out what's happened to the currency. If you just look at the chart on the left, that's the current account as a percent of GDP. Let's just think of the current account as your own bank account. All the red bars, you can see how badly the country was in deficit, basically. We had a budget deficit, which meant that obviously the amount that government spent relative to the tax they collected was a negative. And we had a current account deficit, which means that the amount of money we owed to the rest of the world, or that was flowing out of the country relative to the amount of money that was coming in, was sharply in deficit. So we were always sending money out, and it just put pressure on the currency all the time. But you can see over the last sort of 5 to 7 years, the structural change in our current account, in the performance of the country. We have a lot more South Africans have a lot more foreign investments these days than they ever did. So actually a lot of money comes back into the country from dividends and interest that never used to. There's been a structural change. And with that has come a much more stable rand. If you just look back over the last, this chart does go back 20 years. Every time there was a crisis, the rand would blow out and there would be a flight to safety. Everybody would rush into the dollar, and emerging market currencies would come under pressure. The rand, as being a liquid currency, would come under even more pressure. And just look at how stable the rand has been in this crisis. Again, if I'd said to you 9 months ago there was going to be a war in Iran, the straits are going to be closed, there's going to be 20% of the world's oil was going to be out of circulation, we would have expected the rand to be at 20 to the dollar. And just look at how stable it's been. The rand is at the same level against all the other major currencies that it was in 2016 when we had the weekend special finance minister, Nanny Gate, and all that nonsense going on back then. So again, maybe it's just worth, for us, I think it's just worth reflecting for a moment how far this country has come in the last 5 years. If we hadn't made some of the changes and improvements that we have done, and sometimes it doesn't feel like we're making changes, I can appreciate that, but there are changes going on, we might well have a rand at 20 to the dollar and petrol prices at 35 rand to the litre instead of 28 rand to the litre. So I'm not saying that the petrol prices at 28 rand is good, but I'm just saying that things could be a lot worse if we hadn't started on this journey of reforms and improvement that we've been on for the last couple of years. So there's actually something to be, I think, to reflect on and actually be grateful for. But the chart on the left here is actually a very depressing chart, because the blue line at the bottom just shows how nominal incomes have grown, and roughly they've grown at sort of 4% a year. Which is maybe where you would expect salary increases and things to be. Electricity prices are up 180% over the last 10 years. Petrol prices, and sorry, I didn't adjust this chart for the last, obviously, 6 weeks where prices have gone crazy, but they're up, obviously, over 100%. Inflation is up 60%, and yet we're all poorer because incomes have not kept pace with inflation, and obviously what's driving inflation. So that's a real blight on this country and the wealth of our citizens, and we've talked about it before. But then you look at the chart on the right and say, well, okay, so nominal GDP. So quite often when we talk about GDP, we talk about real GDP. But if you take nominal GDP, which is just the growth rate every year, not adjusting for inflation, nominal GDP grows, and it's grown 400% over the last 20 years. But companies' profits have grown substantially faster than that. And so you might sort of say, well, why do we invest in companies if the economy is not growing and people are getting poorer? But you invest in companies because they go out and do exactly what you want them to do. They go and find new markets, they go and launch new products, they go and expand, they do whatever. And not every company is successful. That's our job, to pick those good ones from the bad ones. But companies generally grow their profits a lot faster than GDP. And that's exactly why you remain invested, even though it doesn't feel like we're going anywhere. Because companies go out, and if you have a good management team behind you, they will go and look for the growth, and they will deliver it. So how does this really impact on portfolio construction and what we do for you every day? How do we take all this that we're talking about and then decide what to do for you every day? So the most depressing part about this slide is that Robin pointed out to me when we were going through it yesterday in the office that Quality Street have been taken off the market. That is a devastating piece of news for anybody who grew up with Quality Street. I didn't think I could find them last Christmas, and obviously it has happened. So maybe we just have to keep this picture here forever, just as a reminder of happier times. But how do we've actually said so many times over the last year or 18 months, we're on this journey to quality, and we're weeding out sort of poor quality stocks and portfolios and moving to quality. And what do we really mean by that? I mean, and I really wanted to spend the last 10 minutes talking about what I mean. So what do we mean by quality? Obviously, you want to have an attractive market positioning, a competitive advantage of some sort. You want a strong balance sheet. You want strong cash flows. I was just saying to everybody here this morning that most people will probably remember when AB InBev, that's Anheuser-Busch, bought SA Breweries in 2017. Back then, interest rates were sort of 1-2%, and it was all the rage to go and do these big corporate deals and issue a lot of debt to pay for them, because interest rates were so low. Why wouldn't you issue debt? 9 years later, and AB InBev has only now really got its debt back under control. 9 years after buying SAB. And it's actually been a very, very poor investment for the last 9 years because they've had too much debt And, the banks always come first, don't they? I mean, if you've got debt in your personal capacity, whether a country has or whether a company has, the bank's always the first person in line. That's why we have bank shares in your portfolio, because they never lose out. But it takes a long time for anybody to get on top of excessive amounts of debt. So we want companies with strong balance sheets, strong cash flows, consistency of growth. Obviously, the dividend's very important to us. And above all, we want companies with good management. And I just want to try and give you 3 examples of what I really mean by this. So let's start with the retail sector. It's obviously facing some quite tough times. People don't have a lot of money, as I showed you in a slide before, and how they spend their money. They're being rather prudent and cautious and circumspect with it, which is exactly what you would expect. So what I've really done here is I've taken 4 clothing sector companies. I've taken Foschini, Truworths, Mr. Price, and Woolworths, and I've just added them together so I don't have too many lines on the chart. And that's the dark blue line. And you can see that from an earnings growth point of view, those 4 companies have basically not grown their profits at all over the last 10 years. Shoprite has grown their profits, Clicks has grown their profits. So these are all companies operating in the same economy. Yes, some of them might go overseas, some of them might not. That's obviously each company's strategic decision on their own. But clothing companies generally haven't grown at all. One of the reasons, on top of that, generally the clothing retailers have more debt than a Shoprite or a Clicks. They have 1.5 to 2 times sort of net debt to EBITDA. And as I said, banks are always the first in line. So you've got to service that debt. If sales are a bit weaker, you pay the bank first, then what's left over goes to shareholders. And then there's not as much left over. And then if you look at how that plays out into dividend growth, you can just see essentially those 4 clothing companies have hardly, they haven't grown their dividends at all over the last 10 years, whereas the other companies have. And that's essentially what we focused on. So there's a lot of focus on the left-hand side of the slide, but what the outcome is on the right-hand side of the slide, and that's where you want to be. And when we say we're moving into quality, we don't want to have Truworths or Foschini or Woolies in our portfolios. Mr. Price is another story, and then I'm not even sure we've got enough wine to talk about Mr. Price tonight either. But we'd much rather have Shoprite and Clicks in our portfolios. And Clicks has always been super expensive. The share price has reflected that amazing earnings growth. But in the last 9 months, it's slightly fallen out of favor. It's the cheapest it's been for 10 years, and this is a great opportunity, in our point of view, to actually buy some Clicks and move into a much higher quality company. So that's the one example. The second example is in mining. Mining is a cyclical industry. There's good times, there's bad times, and when the good times come, it's very good, and when the bad times come, it's very bad. And that's just mining, and you have to get around that. And so in mining, you are going to have cycles, and you're going to have times where share price is really hard and times when they don't. And obviously, we take that into account when we consider what mining shares we want in portfolios. But about 7 or 8 years ago, we kind of recognized that we wanted to have some gold and platinum in portfolios. And we decided to have Sibanye in there because that actually was a combination of gold and platinum. That was one company that had gold mines, it had platinum mines, and we thought, well, that was quite a neat solution. But actually, it proved to be the wrong decision. Sibanye's gold production has fallen by 50% over the last sort of 7 years. AngloGold's production has risen. On the platinum production, it looks like Sibanye's done better than Valterra. Valterra is the new name for Anglo Platinum. But actually, it's only just because of acquisitions that Lonmin's been buying other companies that their production is high. It's not actually because of how they're managing their mines. And then, the other obviously side of a mining equation or any business, I suppose, is costs and how you control your costs. And Sibanye's costs are much higher than either AngloGold's, or cost per unit of gold or platinum produced. The costs are higher, so the margins are more variable. The balance sheet's weaker. They have a significantly amount more debt. So when times are good, that's fine because they can pay off the debt. But when times are bad and you have a weak balance sheet, the bankers are first, then there's nothing left for anybody else. And you can just see that in the table of the consistency of dividends. So yes, there's a cycle, and in good times, mining companies throw off a lot of money and they pay their shareholders a lot of money. But also in the bad times, you want companies that are still able to pay dividends and to survive the bad times. And if you just look at those 3 columns there, you'll see that Sibanye is a significantly more variable company than either Valterra or AngloGold. So that's the second example of what we mean by when we're saying we're moving into quality. It's not that we're moving out of cyclical shares. We still want some cyclical shares. But we want to be in the highest quality cyclical shares. And then finally, I really want to talk about the influence of management, I suppose. So AVI is a company that you might not know. Obviously, it owns a lot of brands, tea, coffee, snacks, Baker's Biscuits, Willard's. It owns a few cosmetics brands, and it owns I&J and a few clothing brands. So it's a company that you probably come into contact with every day, even though you might not know the name. The name AVI. But AVI has the same challenges that every other company in this country faces. They're a very South African company. They don't have any overseas subsidiaries. They do export a little bit, but that's good for them. But they're facing weak consumer demand. They have another pressure of basically the growth of private label. So Spar, Checkers, Woolies, Pick n Pay, they all have their own private label brands that compete with your essentially your company brands, like Five Roses or Freshpack or anything like that. They have currency volatility. If you look at what coffee prices have done over the last sort of 2 years, coffee prices have just gone through the roof. They have to manage all that volatility. They've got inflation. They've got I&J, which is the fishing business, which is exceptionally volatile. It can have a good year and it can have a terrible year. But look at what AVI has managed to do with their margin over the last 10 years. Basically go from 18% to 23%. And it's the same country and the same economy that every other company is operating in. But that's the benefit of good management and just really understanding their business, doing the basics well. And as a result of that, they add a lot of economic value, which is what we talked about last time. And they pay a lot of dividends. And every couple of years, they pay their shareholders a special dividend because they don't know what to do with all the money that they're making. And so again, AVI is a great quality company. You could go and look at another food company, for argument's sake, like a Rhodes or Rainbow Foods or something like that. If things come right in this country, the share price might double from 5 Rand to 10 Rand. But if things don't go right, they're going to halve. So we would much rather be in AVI, which we know is going to deliver the goods, and we have absolute faith in management, than be in a much more cyclical company where it might come right or it might not come right. So that's really the end of my story. We show this slide at most presentations, and it really hasn't changed much. The same sort of themes are continuing to drive markets. There's obviously, as I said right in the beginning, AI is probably the only thing on everybody's lips at the moment. Obviously the big US tech companies, and that spreads through to Asia in terms of the chip manufacturing is obviously all booming. I think AI is a whole other discussion on its own because, I think AI has also become a loose term for anything kind of tech-related at the moment. The companies that are kind of building their AI engines, I suppose, but most companies are implementing some sort of form of AI. I mean, we are at Harvard House too. But it's just another word for implementing technology to make yourselves more efficient. And obviously that's going to roll out across the whole world and make companies more efficient if they harness new technology, I suppose. But we still like the supported consumer. We think there's a lot of more support at the bottom end of the economy than at the top end. There's obviously a lot of infrastructure that's still coming in this country. From a commodity point of view, copper is at record highs. Copper prices are close to $14,000 a ton at the moment. The mining companies are absolutely loving it, and there's just not enough copper in the world to build data centers and to build electrical infrastructure that all this computing power needs. So we talked about that probably 18 months ago or 2 years ago, and it's coming through very nicely. So, I mean, that hasn't really changed, but that really is the end of the story. I think maybe the parting comment is actually is not to look at the headlines too much, everybody, because life does continue. The headlines are headlines, and one lady came up to me this morning who'd been in the journalism industry for a long time, and Robin has a similar sort of phrase to this, but she said to me, this is the phrase that you need to tell your clients: if it bleeds, it leads. So if there's blood, then the headlines will print that, well, the newspapers will print that as a headline, because we all know that only bad news sells. You're not going to go and buy a newspaper if it's about the little fluffy dog that got rescued in the tree. That's just not exciting, you know. Unfortunately, we'd all like a little bit more of that, but it's just not what's exciting and what sells. So in some ways, try and divorce yourselves from all the news and all the headlines. The world goes on, and even if the market has taught you one thing this year, is that despite almost an apocalyptic war that no one would have predicted, and probably almost a doomsday scenario, markets are at record highs because the world continues. AI is driving a whole other generation of technology, and you can get so focused on one aspect that you're missing out what's going on elsewhere. So enjoy your golf, enjoy your walks, enjoy your wine. Let us worry about what's going on in markets. And thank you. I'm very happy to answer any questions, but that's the story. Yes, Nick. Never let me down on a question. Listen, Mondi is actually a great company. It's had a rough couple of years, obviously following the Ukraine invasion. They had to sell their Russian assets. They then distributed that money, but basically a great suite of assets that they'd built up. They were forced to sell a whole chunk of it because of that war and sanctions on Russia. They've basically been reinvesting in capacity for the last sort of 3 to 4 years to replace what they had to sell in Russia. But Mondi basically falls, it's a little bit like Afrimat. Afrimat and Mondi are probably in the same group. I mean, Afrimat's share price has halved over the last 2 years. But it's a case of where we really believe in management and great management teams that we know will deliver over time. So there's a cyclical element to that. But we are prepared to back great management teams because they will get it right. And when things do turn, then it turns very quickly, and you miss out on the recovery that's sort of coming. So yes, we probably didn't expect in either Afrimat or Mondi's case for maybe the drop to be quite as deep as it is, but we firmly believe in the management team, and again, that's where the management comment comes through. So yeah, Daryl? No, I don't think so. Listen, I think technology companies are just sort of in different cycles. So obviously Tencent is in a slightly different cycle to some of the other big tech companies. So I think on the one hand, what's going on in markets is that there's this absolute infatuation with AI. And I think we can probably debate all night the AI bubble or what's going on, but the market is absolutely infatuated with AI and anything related to do with AI. So if you're a sort of tech company and you're not at the absolute cutting edge of AI, you kind of yesterday's story and all the money's being sucked out and put into something that's much more sexy. That's obviously a whole risk in itself. Tencent continues to work on its ecosystem. They announced on Monday that they were deploying sort of agentic AI agents, and the share price was up 10%, And so again, I just think that on the one hand, you've got very fickle markets that are very focused on kind of one aspect, and companies, all these companies are very active doing things, but they roll things out at different times. And at the moment, the market's really only focused on maybe where they can really see the clear winners. But the companies that are just working on building stuff in the background, that's not exciting. When they release some news, then it becomes exciting and the share price reacts. I think that's on the one hand. Prosus has also got a lot of internet businesses and consumer businesses around the world. So some of those are in food delivery. That space is a little bit more competitive. And what all these companies try and do is build an ecosystem where they have you in the ecosystem, and it's very hard. And then they add lots of different products on, and you basically stand there and you spend a lot of money because your food and your air tickets and your pharmacy and everything can be kind of organized through that ecosystem. And Prosus are building that out in Latin America. They're building it out in Europe. And sometimes it takes a little bit more investment, or than maybe it was previously expected, or it's 6 months or 9 months delayed, and then the market just doesn't like that. So I think Naspers is great value at the moment. We're actively buying it. We think it's a great opportunity to buy a great business at a cheap price. But the market's fickle. That's maybe the answer to your question. Yeah. Okay. Yes. I'm not sure if it was today or if it's next week. I think it's next week, is it? Next week. 13th, is it? 12th. So whatever day, next Friday. The market cap is about $1.8 trillion. I think that I've got my facts right. So it's quite unusual. Normally, when a company goes to market and they have what's called a book build, so they'll go out and get bids for shares, they'll have a range. And, as an institution, we might say, well, we're prepared to take 1 million shares at $120 a share, but we're only prepared to take 50,000 shares at $140 a share, and that's how you kind of build a book. SpaceX has come out and said the price is $135 a share. There's no debate. We're not here sitting arguing about it. But that's what the price is, and we'll see whether it works or not. But again, I think it just shows the. I don't think arrogance is the right word, but you could use that word, but I don't think it's the right word. I think it's the hype around AI and how much money is available in the US and how ready markets are to throw money at these things. So obviously within SpaceX, you have the space launching the rocket business. You also have Starlink, which is a very cash generative and profitable business. And you have Twitter and Grok and all the other bits and pieces in there. So it's not just the rocket launches, but yes, it launches, I think, on next Friday, $1.8 trillion. And Anthropic and OpenAI have also filed for IPOs. So those are the two really big. Anthropic is the Claude AI engine, if any of you use Claude. And obviously OpenAI is ChatGPT. And I mean, again, if you just think of those three companies, SpaceX, OpenAI, and Anthropic, you're probably adding $5 trillion of market cap to US indices, which will also change the way indices are calculated and move and things. So it's an interesting time in markets from that point of view. But as I said, we need to have you here for a whole day to debate whether that's a bubble or not. Thank you. Yes. Yeah, listen, I think it's a good topic. And I think, AI has become such a catchword, and everybody's saying AI and AI. But quite often AI is also just using technology and using technology to make your operations more efficient. So yes, obviously AI can do more things, or it can automate processes that weren't automated before. But I think you should almost just view AI as a super efficiency enhancing technology. On the one side, but we'll put it out there that we'll consider that for the next presentation in September. All right, because we'll be probably talking in the office next week about what that topic is. So thank you. Right, everybody, thank you so much for coming. It's cold, but luckily the atmosphere inside is nice and warm, and there's some lovely warm snacks, and there's plenty more wine and things. So really appreciate everybody coming along, and we'll see you next time. Thank you.